You're still with us. Our guest host this half hour, Roger Nightingale in London. He's an economist at RDN Associates. And Ryan Gibbons here with me in the studio, managing partner at GPS Capital Markets. You know, Ryan, we're going to get a lot of data, a lot of news. What do you do right now if you're managing money? Are you just moving it between asset class? Are you looking for value? And how do you even assess value in this environment?
Well, today isn't the day to go in and start doing your investigative work, right? You've done that in the past. You should be in a position on your portfolio where you have looked and taken care of those areas where you think there's some good value, and you should be positioned.
Give me a sector that you like right now.
Boy, I like to go back to the staples, you know, look at energy, look at the things in this type of a market where it's volatile. I like to go back and kind of take a look and say, look at the things that in the long term, let's take a longer play. I'm not in this market for the next 3 days or 5 days here. I'm in it for the long term. You know, what are we looking at 10 years from now? What in the technology field is going to be there? What type of companies are making that? You know, always a big fan of Apple. I love what they do. You know, that's an easy call, but I love seeing what they do, and I look at my own
And would you touch
style.
Financials with the 10-foot pole at this point?
You know, if you look at those and see where they're trading in their book value, and you could you might put a portion of it there, certainly.
Roger, we heard they're talking about the long term. Just talk about what value is there in pension funds in buying government bond debt at these particular yields? I mean, how much is a driver going to be for pension funds who want to put their money anywhere but, in fact, government debt?
Well, I think substantial, and I think the pension funds do exactly what Ryan says. They do their research, they know what sorts of areas they want to be in, and then they wait until they think the timing is right, when they think they have momentum or whatever on their side. Now, my advice to them at the moment is to say, right, there's going to be quite a nice, quite sustained rally at some stage. Pick your stocks, probably go for the higher betas, because in fact they're the ones that do best in a rising market. Have a list of them, and then sit back and wait until you think it's begun, now or a few weeks, a few months' time. And then when you are convinced, perhaps rightly, perhaps wrongly, hopefully rightfully, then you go in there and you buy them. I would go for technology. I wouldn't personally go for oil or commodities. I think, in fact, that's going to be a relatively weak sector. And I wouldn't go for commercial banks, because I think that's going to be a very difficult sector for a long time. But other high beta sectors, I think, will do rather well.
All right. Ryan, you know, it's interesting, neither of you have talked about gold. What a difference a month makes.
Well, you never know, right? I look at gold right now and I say, you know what, there's some room on the upside of this. If I'm just trading technically, only technically on this, I see gold and say, you know what, we've come off hard. We nice run up, we've come off. Even in this market where you would expect gold to settle down, it certainly was the play of choice a month ago.
It certainly was.
But there's a little room on the upside here.
All right, Ryan, thank you so much for joining us this morning, and Roger as well. We're going to leave it here. And thank you for joining us here on Worldwide Exchange. Here in the U.S., I'm Bertha Coombs. Well, joining us now is Ryan Gibbons. He's here with me in the studio. He's a managing partner at GPS Capital Markets. And our guest host, Roger Nightingale, economist at RDN Associates, remains with us in London. Ryan, thanks so much for joining us. You know, we have spent so much time over the last few weeks focused on what's been going on with regulators and leaders in Europe trying to get a handle on the debt situation. Now we're shifting to earnings. Is that likely to sort of fill the void this week as we wait for the next leg of that plan?
It almost feels like a reprieve, doesn't it? It used to be that you held on tight for earnings season and through volatility in the market, but you look, the VIX is down, indices have jumped. I think we're turning the information from, can the politicians get it done, can we fix the mess, to, hey, let's see what's really going on in the marketplace. Let's see what let's see what business is doing.
Although it seems as though business has been able to essentially roll along throughout all of this, corporate profits continue to rise. They've been able to squeeze out a lot of the fat, and they aren't hiring at this point. Normally when we hear a company cut jobs, that's good news. If a company says they're willing to hire, is that good news? Does that say that they're confident now?
You know, the great thing about business is we go through the bottom line and we look at it and we know when it's time to hire, and we know the ratios. We look at those types of things, and we run to a bottom line, whether in the private sector where you're growing investors' equity, or whether you're growing public sector equity. We have to run a bottom line, and we hold ourselves to a monthly, to a quarterly, bottom line that has to be something that we check and see whether or not the people are. Do we have excess capacity? Are we running as efficiently as possible?
So it sounds like you expect companies will continue to just hold tight.
Well, we've all been conservative, haven't we? There's what is there, over $1 trillion on the sidelines. The money is there. The question is do we have the right capacity? Are we ready to explode? I think that in business we're a little more conservative. We look at the approach of let's grow at the right pace and not just blanket it. You know, there isn't any free credit in business.
Roger, we've heard that Roger's pretty pessimistic on the economy, but you're actually quite upbeat, though, that won't impact corporate earnings that much.
Oh, no. As a general rule, in these sorts of situations, profit margins stay very strong. What happens in this sort of environment, as I say, is the wage earner takes the bigger hit, and jobs are lost, costs reduced. Commodity prices fall. You saw what happened to aluminium. It's going to happen to all the other commodity prices. Corporate profit margins will rise. Corporate profits will hold up very well. There'll be lots of money in investors' hands. Interest rates will stay low. This market is going to turn, the equity market's going to turn round. I just don't know when it's going to happen. There's lots of bad economics news. There's lots of good corporate news. I don't know when the balance switches to the bull side. I would personally wait another 2 or 3 months, but I might be wrong. It might be happening now.
Ryan?
Well, it depends on when you want to get in, right? If you feel a little more risk right now, then you get in now and you jump. When you look back and you see, say, a Dow 12.8 in the next month, you get in and say, well, I picked that up. I'm a little bit more on Roger's side. I look and I say, well, let's watch and see what happens here. You've still got Europe that is in a big mess, and let's find out what they're going to do instead of trading based on what we think they're going to do.
Well, what do we do in a sense? Because it feels as though we're stuck in a channel at this point. We rise to a certain amount. We can't seem to get past 1220 on the S&P. We seem to have a bit of a floor, and we'll watch the earnings, but that doesn't seem to be. Is that going to push us higher?
We're going to ultimately wait and see what happens out of the debt issues out of Greece. That we're not going to go anywhere until we see that. This week is fully ahead of great. If we see good earnings, we'll see a nice pop. We'll see euro strength. The first time we see Greek having problems, or Europe having problems with the Greek bailout, then we're going to see dollar strength. We're going to see the indices all fall. It's we're certainly range bound until they get that fixed.
All right, we're going to leave it there for now. I'm going to ask you a little later where we find value now, if that's the case.
Very well.
What sort of strategy to take. Ryan Gibbons, Roger Nightingale, they'll be with us throughout the rest of the half hour, and we still have much more ahead on the program.